May 2026. The stock market stayed near record highs. Airports stayed crowded. Restaurants stayed full. But something else quietly changed. Food insecurity started rising again. Consumer confidence dropped near historic lows. And more Americans quietly financed everyday purchases. Not vacations. Not luxury spending. Basic life, groceries, gas, insurance, rent. At the exact moment headlines described resilience, millions felt something entirely different. Because this economy may not be weakening equally, it may be splitting emotionally, financially, psychologically. And the biggest warning sign might not be unemployment, it might be exhaustion. So why does America still look wealthy, while so many people suddenly feel financially trapped? The strangest part, many economic numbers still look stable. The stock market kept climbing. But then came another signal. Consumer sentiment collapsed again. The University of Michigan index fell sharply during May. That matters more than most people realize. Because sentiment changes behavior. Not immediately, but gradually, quietly. People delay purchases. They postpone moving. They avoid career risks. They cancel vacations. They stop upgrading cars. They keep older phones longer. You can already see it everywhere. Families sitting inside parked cars. Recalculating grocery budgets. Workers scrolling job boards late at night. Parents delaying dentist appointments. Couples quietly discussing second jobs. And yet Wall Street still looked optimistic. That contradiction confused many Americans. Until the deeper mechanism appeared, higher-income Americans kept spending. That became the hidden support beam. Retail earnings recently surprised investors. Travel spending stayed resilient. Luxury experiences remained strong. But lower-income households showed completely different behavior. The New York Fed noticed rising food insecurity. More skipped meals. More needed assistance. And here is the dangerous part. Both realities existed simultaneously. One America still invested aggressively. Another America quietly survived month to month. That creates strange economic illusions. You walk through crowded malls, while credit card balances remain historically elevated. You see packed airports, while many workers avoid checking bank accounts. The pressure hides beneath appearances. Because modern economic stress rarely looks dramatic. It looks normal. People still show up, still spend. But increasingly, they spend through financing. Buy now, pay later, credit cards, personal loans, payment plans. And eventually, that changes household psychology. People stop thinking about building wealth. They start thinking about surviving volatility. That transition changes everything. Then came housing. America's emotional pressure point. Mortgage rates climbed back above 6%. Again, applications weakened. Affordability tightened further, and millions of homeowners refused selling. Not because they loved their homes, because they loved their old mortgage rates. That created a frozen market, a strange national standstill. People wanted mobility without affordability. Young families delayed buying. Older owners delayed downsizing. Workers avoided relocating. Divorced couples sometimes delayed separating financially. Even career decisions changed. A better job elsewhere suddenly carried housing risk. So Americans stayed put. Not necessarily by choice, but by math. And housing affects everything. Consumer spending, birth rates, retirement planning, small businesses, construction jobs, economic mobility. The economy slowly loses flexibility. That may explain another growing trend. Americans increasingly feel stuck. Not poor necessarily, financially anchored. This is where the story becomes deeper. The real shift may not be economic first. It may be psychological. Analysts recently used a strange word, vibe-oppression, meaning the economy functions while people emotionally experience pressure anyway. That sounds irrational initially, until you examine daily life. Insurance costs climbed, utilities stayed elevated, groceries remained expensive, mortgage rates stayed restrictive, retirement anxiety intensified, AI disrupted career confidence, and social media amplified comparison constantly. So even financially stable households felt tension. Not immediate danger, persistent uncertainty. And uncertainty changes spending faster than headlines. People save defensively. They hesitate. They overthink purchases. They avoid risks. Small businesses feel it quickly. Restaurants notice smaller tips. Contractors notice delayed projects. Local stores notice cautious spending. That emotional slowdown spreads quietly, almost invisibly. And here is the surprising reversal. This does not necessarily mean recession immediately. So what does this actually mean for you? First, financial flexibility suddenly matters more. Not status, not appearances. Flexibility. Cash reserves matter. Low-interest debt matters. Reliable income matters. Transferable skills matter. Because uncertain environments reward adaptability. Second, the housing market may stay emotionally difficult longer. Many Americans still expect lower mortgage rates, but inflation pressures remain unpredictable. That means housing affordability may improve slowly, not dramatically. Third, consumer behavior could keep dividing. Higher earners may continue investing aggressively. Asset prices could remain resilient. Meanwhile, middle-income households may prioritize stability instead. That creates a different wealth-building environment. One requiring patience, longer time horizons, and emotional discipline. Finally, your biggest advantage may simply be awareness. Most people only react after economic transitions become obvious. But by then, housing already shifted, jobs already changed, investment opportunities already repriced. The earlier you recognize behavioral changes, the more options you usually keep. And right now, America's biggest economic signal may not be inflation, or interest rates, or stock markets. It may be confidence itself. This episode was never really about consumer sentiment, or mortgage rates, or credit cards. It was about something deeper. A national psychological transition. America still looks financially strong from the outside, but underneath, millions increasingly optimize for resilience instead of growth. That changes spending, career choices, housing decisions, retirement behavior, and eventually, the economy itself. The people recognizing this shift early may position themselves very differently. Less emotional debt, more flexibility, better long-term decisions. Because major economic turning points rarely begin with headlines. They begin with behavior. Quietly, gradually, then suddenly, everyone notices together. If you want to understand those shifts early, before they become obvious, subscribe to Dollar Uncut. And this time, you are not going to miss it.